Well, hello, everyone. Thomas Montgomery with Smart Money Alliance and IIMFL. It's my pleasure to visit with you for a few minutes about an important topic, and that topic is 27 mistakes that will get you denied for business credit and/or loans. We're going to talk a lot about things that you should know, but you may not know because it's not been shared with you. As far as my background, I'm one of the co-founders of IIMFL, and as you may know, we offer a 4-week small business certification program. It's a very effective way for us to both educate and prepare small businesses to access capital. You can look on our website, you can actually see some of the educational messages. We'll assign a financial literacy educator, and we're going to build your loan package. We're going to prepare you to go to funding in just 28 days. Prior to this, I was a full-time college professor, and I actually taught small business management at a community college, semester-long credit earning courses. Prior to that, I was a SCORE mentor, which is a nonprofit organization, and I was the workshop chair for a 14-county area in North Texas. I came out of graduate school, and my first employment was with Deloitte. It was called Deloitte & Touche at the time. Worked as a senior consultant on large capital raises. I've also worked for the SBA, technically the SBDC, which was funded by the SBA, working with small businesses in a similar capacity. I have 2 graduate degrees, one's in finance, an undergraduate degree in accounting. So with all that being said, why does this matter? Why are we talking today about the 27 mistakes? Well, it's important to understand that lenders and credit issuers will often automatically decline you based upon not meeting their approval standards. So you can kind of see it. It's important that if we're going to apply for funding, that we need to meet the underwriting criteria. Now, furthermore, so there's a formula. And if we meet that formula, we typically get approved. And if we don't, we get declined. So knowing this formula is essential. Now, it is also important to realize, and if I could bold anything in this whole PowerPoint, it's this 4th bullet. Each source of capital has its own underwriting criteria. So it's not, oh, I don't qualify, I can't get funded. It's not that at all. We need to figure out what you can qualify for or what we can help you qualify for. So there's many sources of capital, many buckets of money out there. Do not make the mistake of thinking, oh, there's only one type and I either meet that one type's criteria or I can't get money at all. Now, again, we're going to work with you, and that's what the 4-week program is all about, is working with you, assigning a financial literacy educator, and working with you to meet these credibility factors. So we're going to blow through these pretty quickly because I know your time's valuable, but I want to cover this information. I'm going to try to keep it to a minute or less per slide. Then we'll wrap it up, and then we can obviously visit with you individually about your own circumstances. So let's go with mistake number 1, kind of like a game show. Mistake number 1. Business name mismatch. One of the most common reasons for loan and credit applications being denied is that the lender can't easily locate your business online. The business name on your application should be exactly the same as what's listed online and with your Secretary of State. So it's very important that you use your exact business legal name. So you want to ensure that your business name is exactly the same on your corporation papers or your formation papers if you're an LLC or even a DBA, assumed name papers. Any licenses, utility bills, bank statements needs to match up. Also ensure that your business name matches with any online listings. So that's mistake number 1, is when there's a mismatch of the business name. Let's go on to mistake number 2. Not being in good standing. You want to make sure with your Secretary of State that they have all the necessary information for your company and that you're in good standing with them. And make sure that your entity shows that it's active and in good standing. Now keep in mind, typically you're going to need to file annual reports and pay a fee each year to the Secretary of State or a relevant organization to stay active. So understand there is a cost of operating a business. We can go create a hobby and not have all these requirements. But if we're trying to develop and manage an effective, well-ran business, there are expenses that are going to be incurred. And these annual filing reports is one of those. Now, realize capital may be tight, and of course, we're here to help you access the capital you need to do these things, but we just want to make sure that we are on the same page, that it's not free to run a business. High-risk industries. Some lenders will automatically decline you if your name indicates that you're in a high-risk industry. For example, ammunition weapons manufacturing, bail bonds, check cashing agencies, and so forth. Now again, remember what I said earlier, different sources of capital have different underwriting criteria. So this does not mean that this is an issue with all types of capital or all sources of capital, but it often is the case. Other industries that are considered to be high risk are listed here at the bottom of the page. Mistake number 4, entity selection. It's in your best interest, if we're trying to do a capital raise, to have an entity. And what I mean by that is to have filed for an LLC or a corporation. Now, can we get funding with a DBA or an assumed name? Yes, for some sources, but not all. With an SBA loan, we can go file and get an SBA loan up to $150,000 pretty quickly, for example, with just a DBA. But in general, we should have a formal business entity. It's also going to help reduce your liability. Now, the type of entity you form needs to be catered to your specific circumstances. And certainly if we're going to try to go get equity-based capital, then we need to be probably a C corporation. In general, it is best to have your entity set up in the same state as your business address. We have seen some lenders decline this because of a mismatch. And again, hear me out. I'm not saying that each of these rules or mistakes are universally applicable. That is not true. Different sources of capital have different underwriting criteria, but we're giving you the general guidelines, or as it's stated, general mistakes to try to avoid. All right, so we're off to mistake number 5, which is EIN. Regardless if you have employees or not, you should obtain an EIN, employer identification number, sometimes referred to as a TIN, a taxpayer identification number. It's free and easy to get this, so don't worry about that. So just like you as an individual, you have a social security number, your business should have an EIN, a unique identifier. So we're going to need this to open your bank account and to build your business credit profile. Part of our 4-week curriculum, part of the small business certification, is to help you build your business credit profile. We cannot do that without an EIN, or your taxpayer identification number. And again, you can't open a bank account without it either. You want to take the time to verify that all agencies, banks, trade credit vendors, and so forth have you listed properly with your right EIN or tax ID number. And also you want to make sure that the address with the IRS is listed as everywhere else. So that links us to mistake number 6, business address. So in a perfect world, you would have a true physical address. I realize that's not always possible. And again, we're talking about best practices here, but ideally you would have a true business address. Home addresses and post office boxes are often not an adequate substitute. And again, hear me out. I'm not saying that all sources of capital will require this, but we're talking about best practices. Lenders often will check with the United States Postal Service, Google Maps, and other places to verify that your address is accurate and it's listed as a business address. Virtual addresses are a bit of a mixed bag. You know, there's been a huge growth in co-working spaces and virtual offices over the past few years. And it's an option. We need to make sure that our addresses are all matching with whatever our address is at the virtual space. But keep in mind that we do see in some cases that virtual office addresses are being red flagged. So I would say a virtual office address is good, but what's better is to have a real brick and mortar physical address, understanding this may not be attainable for certain businesses at this time. So we move on to mistake number 7, business phone number. We need to have a business phone number. That business phone number should not be your home number. Who has those anymore? Your business phone number should not be your cell phone number. Should not. Now, if it's forwarded to your cell phone and you answer on your cell phone, no one knows, no one cares. So even if you're the only owner of a home-based business, we want to have a business phone number that's properly listed. It's easy and inexpensive to get a virtual phone number. There's services that can provide that for you, and then we can help you get that listed properly so you look credible. Now, I know we live in 2020, or you may even be listening to this in later years, but the bottom line is a fax number is still relevant in the business finance space. And there's places that you can get a virtual fax number without having to have an old-fashioned machine sitting there on your counter. All right, so that takes us to mistake number 8, website and email addresses. It's not unusual before someone extends you credit that they look up your company on the internet. So you should have a website. If you don't have a website, it could hurt your chances of getting business credit or getting funding. Now, the website doesn't have to necessarily be fancy, but it needs to match with who you are and what you say that you do, and also the address. Remember, going back to our earlier mistake, addresses need to match across the board. We need to have a company email address for your business. So we need to stop using Yahoo, America Online, Gmail, or those generic types of email for your business if we want to look as credible as possible. And that's what we're talking about here, right? Building the credibility of our business so we have the greatest access to capital. Do you have to do all these things to access capital? Of course not. But the more that we can do, the more access to capital you'll likely have. Mistake number 9, business bank account. We kind of scraped the surface on this a few minutes ago when we talked about employer identification numbers. Your business banking history is vital to the future success of being able to secure larger business loans. And in fact, the date that you open your business bank account is considered by many lenders as when your business really started. So don't think, oh, I just went and bought a shelf corporation that's 4 years old, or I started this entity many years ago, but it hasn't been active. You can't game the system. Just simply aging based upon when the business was formed is woefully inadequate. It's right here on mistake number 9. It's the aging of your business bank account that is crucial in many cases. Not all cases, but many cases. The longer your business banking history, the better your borrowing potential will be. You might say, well, Tom, that's a problem. I'm a brand new startup. I just opened my bank account. Well, that is what it is, right? But certainly if you just formed your entity, let's not delay in getting the bank account open. So we understand we can't change history, but what we can do is learn these important lessons and assimilate, adopt them to the best of our ability. Many banks will require, or at least expect, that you have an open business checking account. So having a business checking account that they can wire the proceeds of your loan into, or give you rounds of funding off of a trade line, for example, or line of credit, is important. So we need to have a business bank account. Mistake number 10, business licensing. Make sure that you have the proper licensing for your company. Now, this can vary based upon your industry if licenses are even applicable, but we do want to make sure that those addresses match up. So you need to contact your state, county, city governments and see what required licenses or permits that you need for your type of business. Mistake number 11, business credit. And this is an important part of what we do, what we build in our 4-week curriculum, the small business certification. is business credit building. So we often see denials to the applicant because they were not set up with the business credit reporting agencies. So if you've not already got your DUNS number, for example, we'll help you with that, but we need to get your DUNS number. Now, you might have already been assigned a DUNS number and it might not be properly completed, the profile, but there's steps that we'll go through, and that's part of the 4-week process. You will often get declined if you're not listed with the business credit reporting agencies or if you don't have established business credit. Again, we can help you. It's in the 4-week program, grant subsidized, don't worry about it. Mistake number 12, inadequate business credit scores. So we're building off of 11, which was not having a profile. Now we're talking about we haven't taken that profile and built out the business credit scores. So you should at least have established credible business credit ratings with at least Dun & Bradstreet, D&B for short, and Experian Business. Those scores range from 0 to 100. What we're going to do is work with you to get at least to 80. If we're 80 or higher, we're okay. That's part of what we're going to do during the 4-week curriculum is get your profiles correct, help you build out your scores so you look good on paper, because business credit operates much differently than personal credit. Business credit is publicly available. Anyone can see it. So we need to manage how we look to lenders as well as to the public. So with Dun & Bradstreet, it's called a PAYDEX score, again, on the same scale, 0 to 100. And Experian has Experian Business with an IntelliScore, but we'll help you with that. Now, once we have an 80 on each, we can continue to build and increase, but we need to get at least an 80 on those two. If you don't have it in place, not a concern, we're going to help you with that. Mistake number 13, inadequate personal credit scores. Now, is it true that personal credit, excuse me, matters for all types of sources of capital? No, there are some sources that don't look at personal credit at all, but we're talking about best practices here. So we need to do what we can to optimize both our business credit, which we just talked about for 2 slides, and personal credit. Even the SBA, you know, we can get an SBA loan with not perfect credit. They use a different credit scoring algorithm called the FICO SBSS. We only need a 145 to a 160 FICO score to get approved. But credit scores obviously reflect how we've managed our debts in the past and if we've done what we said that we would do. And if we haven't demonstrated that, it doesn't prevent us from getting all sources of capital, but obviously it doesn't make us look as credible as possible. And that's the theme that you see here, is that we need to look as credible as possible. All right, and so we should also be monitoring and managing our credit so you know how your scores are doing, because credit is fluid. It'll go up and down as you utilize it. And so we need to be monitoring, especially if we're in the market to access capital. And again, we can help you with this. Mistake number 14, collateral. Collateral, while accessing business credit does not take into consideration collateral, many loans will. So again, different sources of capital have different requirements. Collateral is the term that means, what are you pledging? What are you putting up in case of default? So the lender could come take it and hopefully sell it and recoup their losses. No lender in the world wants you to default on a loan, and absolutely no lender in the world wants to come take your collateral. But collateral is what can give them confidence in extending loans to you because they have some asset tied to it. Again, different lenders and different loans have varying collateral requirements, and there are some that don't care about collateral at all. It's the same theme we've gone through in most of these slides. This is not a universally true statement for all sources of capital, but it is a best practice. It is an important part of getting your business as credible as possible. Now, some lenders will take personal assets that can even be pledged. We had one lady, she pledged 300 pairs of shoes as collateral for her business loan. So it'll vary. In some cases, we can pledge the asset that we're buying as collateral. So let's say we went and bought a new business vehicle. We can buy a business vehicle for your business under your EINs. That ties back to business credit, so it doesn't show on your personal credit. And that vehicle, of course, could be the collateral. If we're buying real estate, the real estate can be the collateral. But when we get into working capital loans and such, now there's often not specific tangible assets tied to that funding, and therefore other collateral can become more important. Mistake number 15, business plan. Again, I apologize. I know we're going through this quickly. We're trying to keep it to 1 minute per slide. Mistake number 15, business plan. We need to have a business plan. Is it true that all sources of funding require a business plan? No, but every business should have a business plan because it's a very important internal instrument as well as for lenders. Now, different lenders have different requirements for business plans. For example, one of our most popular SBA lenders, they only require a 1 to 2 page business plan. So it varies, but regardless, it's going to be very difficult to reach our potential if we've not gone through that thought-provoking process of building out a diligent business plan. So we're going to help you create one, and that's part of the small business certification. Mistake 16, financial projections. Guess what? We need them. Who knows exactly what the future will hold, but we need to at least take a stab at what we think our revenue will be, our expenses, and thus our profit. Because for many types of lenders, this gives them confidence. Well, it looks like from what you're projecting, you'll be able to afford to pay us back. Because that's what a lender wants, right? They want to be paid back. That's all they want. They just want you to pay them back. And so they're going to apply filters to see if they think that you're likely to pay them back. Now, there's different types of capital, like equity-based capital, where it's investors, a little different scenario, but let's continue on. Typically, we need financial projections projected out 36 months. That's what we do by default. We're going to help you put that together. It's going to look nice, graphs, and so forth. But we do ultimately need to meet the expectations of the lenders, and different lenders may have specific requirements when it comes to this. And we're going to help you do that through the small business certification. Mistake 17, uses of funds. We need to have a crystal clear idea of what we're going to use the money for and how much money we need. This is one of the mesmerizing mistakes that many small business owners will make. Oh, I just need around 100,000. That doesn't work. We need to state exactly how much we want and what we're going to use it for. This is that shopping list of what you're going to buy. That's going to help us help you identify what the right type of capital raise is, because different uses of funds are better fit for different types of capital raises. So we're going to help you through that, and that's part of the 4-week curriculum. All right, we're on to mistake number 18, industry experience. And again, you heard me say this multiple times. This isn't always relevant, but it often is relevant. So we're learning about credibility factors, aren't we? So while business credit is great about showing how your business has paid its obligations, what it doesn't pick up is your industry experience. Different sources of capital have different requirements, but if we're going to go after a traditional loan, they often will look at your education and experience as how it applies to the type of funding for the type of business that you're pursuing. So for example, if you wanted to go out and buy a food truck, the bank's going to be concerned, do you have any experience owning a food truck, or at least operating, working on a food truck? If not, then a traditional loan would be less of a good fit. We'll probably have to go to another source. When I was still with the SBA, I was working with a father and a son. The son was a welder, very successful, and the father had the better credit. So the father was trying to really take control of getting the loan. We couldn't get that SBA loan approved because the father did not have relevant industry experience. We had to add the son to the ownership team of the business, because now the borrower, or one of the borrowers, had relevant industry experience. So one of the things that we do when building your loan package through the 4-week program is putting together your bio that highlights these things. Now, it's okay if you want to go into a different industry than you've worked in before. That's not a barrier, but we need to know that because it's going to affect the type of capital that we pursue. Mistake number 19, advisors. You need to have an advisory team. Do not go this alone. Do not be a lone ranger. Most businesses should have a CPA. They're going to provide you tax guidance and tax return preparation. They may even help you with your QuickBooks or your bookkeeping task. You need to have an attorney that's going to help with formation issues, compliance issues, accounts receivable, contracts, etc. Many of you will benefit from having a business coach for that strategy and accountability, what you do after you get funded. And you're going to need an insurance agent that's going to help you make sure that you have proper coverage at the right price. And in many cases, the design of it is crucial. And then lastly, hopefully, you'll allow us to be your capital advisor. I've shared with you my bio. I'm obviously qualified and very interested in being your capital advisor. And to do that, we simply enroll you in the 4-week small business certification. So, do you have to have all these to raise capital? No. Does it improve your credibility if you have more of these than less? Yes. And it's also going to improve your business plan because there's an area in the business plan that we can actually list who your advisory team is. Again, you might say, well, this is a problem. I don't have any cash. That's why I'm trying to raise capital. I don't have money to go hire an attorney or a CPA. We can work around that. I'm just telling you what's best, how to look as credible as possible. Mistake number 20, feasibility data. While accessing business credit itself doesn't take into consideration feasibility data, many traditional business lenders would like to see third-party substantiation to support your assumptions. So when I say, my business is going to grow by 20% a year for the next 3 years, ideally, there's some substantiation behind that. And that could also address validation of target market competitors and so forth. It's going to improve lender confidence is what it's going to do. Again, we can help you with this if you don't have it in place. Target market. We need to know who our target market is and how we're going to reach them in terms of their income, their age, their race, their gender. This is nothing about discrimination. This is about we need to know who our primary buyers of our product or service is because our sales and marketing strategy needs to match that. It's very dangerous to say, oh, everyone, because you figure out how to get enough money to market to everyone. There's over 300 million everyone's across the United States. Very few companies have enough capital to market to everyone. So we need to have a defined target market. Again, this is going to build into the business plan, which is part of the loan package, which is part of the 4-week small business certification. So how many people are in that target market? What percent of penetration do we expect to have? We'll get into more of this on the next slide. If you don't have this, it's okay. It's part of what we do when we build out the loan package. Mistake number 22, we need to have a method to generate leads. I think probably the number one reason that small businesses fail is they don't have adequate leads, right? Because before you have sales, you need to have leads. So if we have leads, that can result into sales, which can result in cash flow. And we need to have a way to get leads. So we need to be able to describe in our business plan and understand our model of generating leads. So in general, inadequate leads equals financial trouble. What does a lender not want? What does an investor not want? Financial trouble, where their money's at risk. So we need to show that we have proficiency and competency in generating leads. We can help you with that. Mistake number 23, inadequate insurance. Oh my goodness, insurance? I have to have insurance? Yes, you do. If you're going to run a business properly, you need to have insurance. If you want to be a homeowner, you need to have insurance. If you want to own a car, you have to have insurance. Now let's talk about business insurance. There's different types of business insurance. If you're going to borrow money, typically we're going to want to set up a key person policy. If you have partners, you're usually going to want to have a buy-sell policy. If you have employees, depending upon the state you're in, workers' compensation probably is required. You might want to have health insurance. You might want to have other types of benefits as well. Business insurance policies are different than personal policies. Let's look at a KPP, a key person policy, for example. So when a key person policy is developed, it's usually owned by the business. You as an individual shouldn't own it. The business owns it. You shouldn't pay for it. The business pays for it. You're not the beneficiary. You would be the insured, the key person. The business is the beneficiary. And then what happens is often lenders will want a collateral assignment. So if they've loaned you $100,000 and the key person dies, the insurance policy pays out to the business itself. The business is the owner and the beneficiary, but the lender gets money off the top only equal to their exposure, whatever their open note is. So they get paid in full. Because what most lenders know, for small businesses, if the key person dies, usually the business will not continue to exist. We have financial literacy educators that's going to assist you with this. Mistake number 24, we're almost there, only 27 total, a couple more to go. Inadequate cash contribution. Again, different sources of capital have different requirements, and some don't have any cash contribution requirements, but traditional loans often are going to look for you to contribute towards the capital raise. It's difficult to get 100% financing. So with that being said, let's say we want to go borrow $100,000. In a traditional loan, they would look for you to bring $20,000 to the table, and then the bank would loan you the balance, 80%. Now, we can work around that because, again, some sources of capital don't require that, and we can even layer in contributions. But in general, what you want to understand is that traditional loans, especially, are not going to normally 100% finance your business. They're going to look for you to have some contribution. And that makes sense because that means you have skin in the game. And in many cases, we'll actually have to source, that's the verb, it's in quotes, we'll have to source the capital to show that it's been contributed. So don't let this be intimidating. I know some of us are running on pretty thin funds in today's economic environment. Different sources of capital have different requirements, but for a traditional loan, we need to go into the mindset, we're not going to go buy a $2 million apartment complex and put $0 into it. Now, we might layer in, so in the end, we didn't put any into it, but from the lender's perspective, one lender's typically not going to want to have the exposure of 100% of the capital raise. Mistake number 25, not running your business like a business. This is a whole conversation in itself, so we'll just hit the highlights. There are many examples. We need to be tracking our revenue and expenses using QuickBooks or something similar to. We can do it ourselves or we can outsource, but we're not going to be able to produce the financial statements like balance sheets and income statements that we need if we're not tracking revenue expenses properly. We do not want to be self-employed. We can own our own business, but we should be pulling a W-2 paycheck however we can, because A, that's going to reduce your self-employment taxes. And secondly, it's going to position you even better for a capital raise. The lending world likes W-2 better than 1099. You might say, well, I can't help it. I'm paid 1099. I'm a realtor, I'm an insurance agent, whatever. Well, you can have that money go into a business account, and then you can pay yourself W-2 out of that. There's no excuse from these bullets other than ignorance and an unwillingness to do it. So again, we mentioned early on, it takes the proper setup for your business to look credible. Now, there can be different degrees of credibility, and not all sources of capital require the same credibility requirements. But owning a business isn't as simple as, oh, I have an idea, now I can go raise capital. There's going to be requirements, obligations, and structure necessary to properly set up and run a business. Now, you might say, great, I want to run a business and I want to do it right, but I don't have the capital. Well, we can help you with that, and we'll talk a little bit more about it in another slide. We have what's called the Opportunity Fund that can get you anywhere from $2,500 to $10,000 a month in working capital, so we can build this infrastructure that's needed. Mistake number 26, picking the wrong business for your circumstances. This is a sensitive one, right? Because we live in America. We should all be able to live the American dream. But I'll tell you, if I just decided I wanted to mimic Elon Musk and go start my own Tesla company or SpaceX, I don't have the capital, the credit, the capacity to go raise $1 billion. Maybe you do, I don't. And so this isn't meant to be limiting, but we need to work within our circumstances. So can we all be all that we want to be over time? Of course. But there may have to be some realistic expectations, and we may have to go through some tranches of capital to build to get there. Not all of us are going to just automatically go get $1 million or even 100,000. It may take some stair steps. So we need to determine our access to capital and then build the business plan to match the circumstances. That's how our 4-week small business certification is set up. Now, pretty much in general, getting at least 100,000 for just about any circumstance is purely possible. However, when we get to larger and larger amounts, it's not true that everyone will qualify now or in the near term for millions of dollars. We have to meet the underwriting criteria. We have to be credible. We have to meet the circumstances required by the source of capital that we're pursuing. All right, and so again, the opportunity fund we can more visit about offline, but it's that secret sauce because some people just need earned income. They just need cash flow, and frankly, that's where the opportunity fund comes in. Okay, mistake number 27. Here we are down to the tail end. The wrong source of capital is mistake number 27. So we've said it many times, didn't we? Different sources of capital have different underwriting criteria. Therefore, it's crucial that we're finding the right type of funds for your circumstances. How do we do that? We gather the data. The analogy I like to give is, let's imagine you and I are going to make dinner together tonight. So we go open up the refrigerator and we see what's in the refrigerator. What ingredients do we have to make dinner? That's what we're going to go through and see what ingredients you have for a capital raise now. What can we do now? That doesn't mean that we can't go to the store, I guess, is the analogy, that we can't get more ingredients as we go along and make more elaborate things. But, we're not going to make lobster ravioli tonight if we don't have the required ingredients. So we want to make sure that we meet the underwriting criteria for the capital raise that we're pursuing. Could be in multiple steps. Any business can get at least 100,000. Maybe not immediately, but within a reasonable amount of time. But the larger the capital raise, as you would expect, the more scrutiny and the more credibility that we need. All right, so with that, we've covered a lot of information in just over 30 minutes. You'll see our website, our phone number, our email address. I encourage you to go take a look at the Small Business Certification Program on our website. You can actually preview each of the 4 educational messages. But this isn't some class, some lecture that we're talking about. We're going to improve your financial literacy, a topic each week. We're going to assign a financial literacy educator who's going to work with, work with you to implement what you've learned. And at the end of the 4 weeks, we're going to have that loan package. We're going to have a much better positioned business to go raise capital. Because what we've talked about is what? Different sources of capital have different underwriting criteria. However, we need to find the right source of capital. We need to meet the underwriting criteria for it. We need to look credible. In these 27 mistakes, we can look at it 2 different ways. We talked about mistakes to avoid, but also lessons to learn. What are things that we can do to make our business look more credible as possible? The more credible we are, the more access to capital we have, both in terms of more sources and greater amounts. Thank you so much for your time. I've enjoyed this conversation. Look forward to working with you directly. Please get on our website, iimfl.org. Go to the Small Business Certification page. Down at the bottom, submit an inquiry, and we'd love to work with you. Have a great day. Thank you.